Welcome to StokTok's deep dive into Fox Corp. Fox Corp is a diversified media conglomerate that operates television broadcasting, cable networks, and digital content platforms serving audiences across news, sports, entertainment, and factual programming. It is one of the largest media companies by reach in the United States, generating revenue from advertising, affiliate fees, and content licensing. As of May 8, the stock is trading near $62.94. Over the past 52 weeks, Fox Corp has traded between a high of $76.39 and a low of $52.02, positioning the current price roughly in the middle of that historical range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Fox Corp generates revenue through multiple streams: advertising on its broadcast and cable networks, affiliate fees paid by cable and satellite providers who carry Fox channels, content licensing deals, and digital subscriptions. The company's competitive moat rests on brand strength. The Fox brand commands loyal audiences in news and sports, and on the scarcity of broadcast licenses and premium sports rights. These assets create pricing power with advertisers and cable distributors. However, the media industry faces secular headwinds: cord-cutting pressure, shifting advertising dollars to digital platforms, and rising content costs. Our StokTok score for Fox Corp is 55 out of 100, signaling a hold. Valuation scores well at 17 out of 20. Financial health comes in at 15 out of 20. Profitability rates 12 out of 20. Growth is the weakest dimension at 9 out of 20. And smart money sentiment is very modest at 2 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? Fox Corp trades at a price-to-earnings multiple of 14.88 times trailing 12 months earnings. That is below the historical media sector average, suggesting the market is not assigning a premium valuation to the company. The price-to-earnings to growth ratio, or PEG, sits at 0.94, indicating the stock is trading at a discount relative to its growth rate, a theoretically attractive signal, though growth itself is modest. The forward price-to-earnings multiple is 12.13 times, implying the market expects some earnings expansion ahead. On an enterprise value to EBITDA basis, a measure that accounts for debt, the company trades at 9.13 times EBITDA. These multiples collectively suggest the market is pricing in some skepticism about the media industry's long-term trajectory. The economic moat is real. Brand value and content assets create competitive advantages. However, structural industry headwinds, cord-cutting and advertising migration to digital, weigh on how much premium investors should assign. Our DCF analysis suggests the stock is trading at parity to intrinsic value, with 0% margin of safety. This means the current price is roughly in line with our estimate of fair value based on cash flow projections. Wall Street's consensus is more bullish. 17 analysts covering the stock have a mean price target of $71, with a high estimate of $97 and a low of $45. This implies roughly 13% upside from current levels to the consensus mean target. Earnings will provide a near-term catalyst. The next earnings date is May 11, 2026, with consensus EPS estimate of 0.97 and a range from 0.66 to 1.26. Taking both signals together, a reasonable fair value range in our view sits between $65 and $75, representing roughly 3 to 19% upside from current levels. Market sentiment around Fox Corp leans neutral. Positive signals from record market highs and strong corporate earnings are offset by broader concerns about cost of living and critical political commentary. This mixed sentiment reinforces a wait-and-see valuation posture. Moving to financial strength, how solid is the foundation? The Piotroski F-score measures 9 dimensions of balance sheet and income statement health: asset quality, cash flow generation, leverage, and liquidity. Fox Corp scores 7 out of 9, which is healthy. This indicates strong fundamentals across most dimensions, though not perfect. A score of 9 would suggest minimal financial distress risk. The Altman Z score, a bankruptcy prediction model, stands at 3.19, Any score above 2.99 suggests the company is in the safe zone, with low bankruptcy risk. Fox Corp sits just above that threshold, indicating financial stability but not excessive cushion. On leverage, the company carries a debt-to-equity ratio of 0.69, meaning it has roughly 69 cents of debt for every dollar of equity. This is moderate for a capital-intensive media business. Cash-to-debt ratio is 0.27, indicating the company holds about 27 cents of cash for every dollar of debt, not excessive liquidity, but serviceable. Interest coverage stands at 7.81 times, meaning the company generates enough operating income to cover its interest payments nearly 8 times over. This is a strong signal that debt service is not at risk. Current ratio is 2.78, indicating $2.78 of current assets for every dollar of current liabilities, solid short-term liquidity. The balance sheet is not a weakness for Fox Corp. Debt levels are manageable, cash generation is adequate, and the risk of financial distress is low. The constraint is not financial health, but rather the need to refinance and the interest rate environment. Next up, profitability. Is this business actually making money efficiently? The most important profitability metric is return on invested capital, or return on invested capital, which measures how effectively the company deploys capital to generate returns. Fox Corp's return on invested capital is 14.16%, a solid figure that exceeds typical cost of capital, indicating the business is creating value with its investments. Operating margin, which measures profitability before interest and taxes, stands at 19.03%. This is healthy. For every dollar of revenue, the company retains roughly 19 cents as operating profit. This reflects the leverage of the broadcast and cable model once content costs are absorbed. Net margin, the bottom line, is 11.41%, meaning 11 cents of every revenue dollar flows to net income after all expenses. This is respectable, though lower than operating margin due to interest and tax burdens. Free cash flow margin, which measures cash available for reinvestment and distributions, is 13.93%. This is a strong signal. The company converts more than 13% of revenue into cash it can actually spend. Gross margin for a media company is less meaningful, as the business is primarily about content and distribution, not physical goods, so we do not anchor heavily on that figure. The profitability picture is solid. The business generates strong returns on capital, converts sales into operating profit at a healthy rate, and produces meaningful free cash flow. This supports the dividend yield of 0.90% and the ability to service debt. Profitability is a strength, not a weakness. On to growth. Is this business expanding, and at what rate? Over the past 3 years, Fox Corp's revenue has grown at 5.3% annually. Over the past 5 years, revenue growth has been 11.7% annually. The 5-year rate is notably higher than the 3-year rate, suggesting the company has been facing growth deceleration recently. This is consistent with secular pressures in the media industry. Cord-cutting reduces cable affiliate fees, and streaming platforms fragment advertising spending. Book value per share, the accounting value of equity, has grown at 9.2% over the past 3 years. The dividend yield is 0.90%, a modest income component reflecting the company's preference to retain cash for debt reduction and content investment, rather than aggressive shareholder distributions. The growth picture is the weakest dimension of Fox Corp's investment case. Single-digit to low double-digit revenue expansion in a mature industry is not particularly compelling compared to growth elsewhere in the market. The company is harvesting cash from a stable but slowly declining base. For a value investor seeking yield and cash generation, this is tolerable. For a growth investor, it is insufficient. This is why the StokTok growth score is only 9 out of 20. Now let's talk smart money. What institutional capital is actually doing with this name? Among the largest institutional investors tracked by Dataroma, 9 top-tier investment gurus currently hold Fox Corp. However, their recent activity sends a caution signal. Yacktman Asset Management, which holds 0.93% of its portfolio in Fox Corp, has reduced its position by 1.14%. Dodge and Cox funds, holding 0.46% of its portfolio in the stock, has reduced by a much larger 11.7%. This is a notable retrenchment by two established, disciplined value managers. Regarding the broader institutional base, only 4.2% of 13F filing institutions are net buyers, meaning they are increasing positions. In the context of an institutional universe where bullish positioning would show 30% or more of filers as net buyers, this figure of 4.2% is quite bearish. It signals that large asset managers are not rushing to add to Fox Corp exposure. Insider ownership stands at 0.45%, very low. Management is not heavily invested in the company itself, which can signal misaligned incentives. Over the last 3 months, there have been 0 insider buys and 0 insider sells, suggesting no conviction from insiders either direction. The smart money picture is a red flag. The Guru holders are trimming, the broad institutional base is not buying, and management has skin in the game. For a mature, profitable, dividend-paying stock, this lack of smart money enthusiasm is worth noting. It suggests that experienced investors do not see a compelling margin of safety or growth catalyst at current valuation levels. And finally, the verdict. Let's bring it all together. On valuation, the stock trades at a fair multiple relative to peers in the broader market, with analyst targets suggesting modest upside, though our DCF model suggests the stock is fairly priced with no safety margin built in. On financial strength, the balance sheet is solid, with manageable leverage, strong interest coverage, and low bankruptcy risk. This is not a concern. On profitability, the business generates strong returns on capital and converts revenue into cash effectively, supporting both debt service and dividends. This is a strength. On growth, the company faces low single-digit to low double-digit expansion, reflecting industry maturity and secular headwinds. This is a material constraint. On smart money, established gurus are trimming positions, the broader institutional base is not buying, and insiders show no conviction. This signals skepticism among experienced investors. In our view, a fair value range for Fox Corp sits between $65 and $75, representing roughly 3 to 19% upside from current levels. This assumes the company can stabilize revenue and margins amid cord-cutting pressures and digital disruption. The market is not mispricingly discounting the stock. Rather, it is appropriately skeptical about long-term growth prospects in traditional media. The investment thesis rests on accepting that this is a mature, cash-generative, moderately leveraged media company, not a growth story. For value-oriented investors seeking dividend income and capital stability, Fox Corp may merit a position. For those seeking growth or a compelling margin of safety, other opportunities warrant consideration. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Fox Corp. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.